Good afternoon, everyone. My name is Keelan Chapman, and thank you for joining us today, and welcome to our Canadian residential property market update. My name is Keelan Chapman. I'm the director and founder of the Canadian Real Estate Investment Center, Hong Kong, and an EXCO member of the Canadian Chamber of Commerce in Hong Kong, a nonprofit, non-governmental organization that was created in 1977. Today, we have over 2,000 members representing nearly 300 companies. This makes us one of the largest Canadian business organizations outside of Canada and one of the most active international chambers in Hong Kong. For non-Canadians, it's also important for you to know that we are inclusive and a diverse community. In fact, about 40% of our membership is non-Canadian. Therefore, everyone is welcome. So what do we exactly do? We deliver 4 services to our members, which include representation and advocacy engagement, business promotion, networking and brand exposure, learning and training, and information and insight. So today we're bringing you a conversation with myself, Michelle Teo from RBC, and Wei Kang from Stevenson Harwood. So without further ado, let me share my screen and get to the presentation. So today we'll be giving you a Canadian property market update along with some information regarding financing and taxes, because those tend to be the most sought after topics when discussing about Canadian property. So for today's agenda, I'll briefly talk about the 3 main markets in Canada: Vancouver, Toronto, and Montreal. Quickly go through a few of the property taxes, and of course, some of the new regulations put forth by the government of Canada earlier on in the budget that was just announced. Then Michelle will talk about financing, and then Wei will talk about key tax preparations if you're looking to buy property in Canada, or if you're looking to move to Canada and buy property. So without further ado, I'll start with Metro Vancouver, because that tends to be the most popular market in Hong Kong. So I'm sure a lot of you have been reading the news and following the property markets in Canada over COVID. And it's actually been a bit of a whirlwind in Canada, real estate wise. During COVID, prices have gone up all across the country, not just Vancouver, Toronto, Montreal. Places such as Ottawa, Halifax, Winnipeg, Edmonton, what we sort of call the tier 2 markets or tier 3 markets, have all seen huge rises in prices, sales, and activity. However, as Canada has moved on from the COVID measures that were put in place and is now sort of entering the post-COVID era, we see that things have reacted accordingly. So if you look at the prices year on changes, we can see that the single detached house market has grown 21%, townhomes 25%, and condominiums 16%. The number of listings, however, has gone down. So people know that there are not as many buyers on the market right now, so listings have gone down. And as a result, sales have gone down as well. So you can see that the number of sales for homes, townhomes, and condominiums have all gone down, especially single detached homes, because the phenomenon that we experienced during COVID was that people were looking to move from their condos where they were maybe closer to downtown or more in an urban center, and wanted to have access to more space because they were working from home, because their kids were at homeschooled or staying at home because they couldn't go to school, and as a result wanted more space to accommodate those needs. So they're buying homes in the suburbs or just a little bit outside of downtown. So single detached homes became very, very, very popular. So how does that sort of track compared to previous years? So I know this is quite an extensive graph regarding price ranges and price growth in Vancouver over time, but we could see that detached homes having increasing. COVID, you can see, is in 2019. So you can see that during that period there was a huge spike in prices. In terms of the city of Toronto, similar trends as well. I would say the prices have gone up as much as Vancouver has, but they have indeed gone up. Single detached homes gone up 15%, townhomes up 14%, and condominiums up 13%. Same thing, number of listings is going down, and the sales year-on-year change have gone down as well. So one of the points that I put here is that the housing market continued to its adjustment to higher borrowing costs, with a number of transactions down on a monthly and annual basis. So as you've all heard, as you guys have probably seen, the Bank of Canada has increased interest rates. And so as a result, we're not going to see as many people purchase property on the market right now, as they're just going to see what happens to interest rates. And I'll let Michelle talk about that a little bit more further down in the presentation. So similar graph to the properties in Vancouver, we can see that from 2019, when COVID was occurred, that there was a big jump in prices year on year. And one thing that I did fail to mention, the reason why people were buying properties in Canada during that time, where there was such appetite for properties, was that several factors. So the number one factor, which I mentioned to you before, was wanting more space. B was that financing was very, very cheap. It was very, not quite all-time lows, but very close to all-time lows. It was very cheap to borrow money. And also there was a lot of pent-up cash in the market. So despite, the news saying that people are losing their jobs, there was also a lot of people that were saving a lot of money. People weren't going on holiday, people weren't going out for dinners, people weren't spending as much as they usually would do, and as a result had more disposable income to purchase property, whether it be for self-use or for investment. And finally, with the island of Montreal, the benchmark prices year-on-year change as well grew 14% for single detached homes, 9% for townhomes, 12% for condominiums. Sales also down along with the number of listings. So things actually dropped quite a bit in Montreal. So sales continue to drop in the greater Montreal area, making it the least active month of April since 2017. So overall, the property market in Canada is slowing down right now. And here you go, here's just another graph to illustrate the Montreal's average price over the years. And same thing, since 2019 to 2021, we've seen solid increase in prices. So let me move on to the taxes. So these are always important things to know when buying property in Canada, and also common questions that I get. So what are the taxes involved in buying property in Canada? So the common taxes that you're going to have to pay are property transfer tax, which is essentially transfer of ownership of the property from one owner to another. Annual property tax, so those are the taxes that you pay on an annual basis. School tax, then after, if you have a property that you're using as a source of income, so you're renting it out, you'll have to pay income tax on that. And also capital gains tax when you sell the property. When buying pre-sale, so the difference between resale and pre-sale. So resale is properties that are already on the market, and resale are properties that are already on the market, and pre-sale are ones that are being constructed and will be completed in the future. The difference between pre-sale and resale in terms of taxes is that pre-sale properties are subject to GST and other taxes. So in BC, you'll have to add 5% of GST on top of the purchase price, or on the purchase price. In Quebec, you'll have to add QST and GST. So QST is 9.95, and after GST is 5%. So in total, 14.95%. And in Toronto, when buying a pre-sale property, you'll have to pay what's called HST, which is 13%, and that includes the 5% GST. So that's essentially the main difference between resale and pre-sale, is essentially just the GST, HST, QST addition. However, it is important to note that these taxes are paid on completion when it comes to the pre-sale. On resale, you have to pay all the taxes during the purchasing process of the property. So what are property transfer taxes? What is the amount? So what I've done is I've broken them down from BC, Ontario, and Quebec. So in BC, the property transfer tax is 1% on the first $200,000. This is on the purchase price, not on the listing price. This is on the purchase price of the property. 2% of the portion of the fair market value greater than 200,000 and up to and including 2 million, and 3% on the portion of the fair market value greater than 2 million. It's important to note that a new rule as of 2018 is that if the property is residential, a further 2% of the portion of the fair market value is added if it is greater than $3 million. There are exemptions to paying property transfer tax, and they do vary from province to province. In BC, if it's your first time buying a home, generally speaking, you are exempt from paying the property transfer tax. So what this means is that, for example, if your property you're buying is worth, let's say, 2.2 million Canadian dollars, you'd be paying 1% on that first $200,000, then another 2% on the remainder, 2% of 2 million Canadian dollars. So for Ontario, property transfer taxes are relatively similar from province to province. In Ontario, the property transfer tax is 0.5 on the first 55,000, 1% between 55 to 250,000, 1.5 between 250 and 400,000, 2% between 400 and 2 million, and then 2.5% over $2 million. So the same thing in terms of the rebates. If you're a first-time home buyer, you get a full tax refund of prices up to $368,333, and then you get a $4,000 refund for anything above that amount. And for Quebec, similar, 0.5 on the first 51,700 Canadian dollars, 1%, 1.5 to, you can see the breakdown on the left. And in terms of the rebates or the exceptions, you can see that there are a few different ones. So it really depends on if you're a single buyer and if you have children. So you get 100% rebate if you're a household with a minimum one child of under 18 years old, and the property value is under $280,000. Or if you already bought a property prior to 2018 and you have a child under 18 and the property price is under $360,000. So I often get the question, what are annual property taxes and what do they include? So the annual property taxes are taxes that you pay on the assessed value of your property. So depending on which jurisdiction you live, there are different tax rates on the annual property tax. And this money is essentially raised for the services that the city provides to you in your area. So everything from police and fire protection, emergency rescue services, schools, hospitals, parks. So the amount you pay is based on the funds needed to provide those services for the year. And as I mentioned, the government will actually assess the value of your property. So you're not paid on the sale price or the purchase price of your property. The tax rate is determined, or the amount that you're going to be taxed is the tax rate times the assessed value of your property. So here, just for example, for the city of Vancouver, you pay the following dollars amount in tax for every $1,000 of your property taxable value. So you can see that general purpose tax levy is $1.5 per $1,000. School tax is roughly $1 per $1,000 of the property value. And then after the city of Richmond on the right. So you can see that they're relatively similar. You're not going to see huge discrepancy between jurisdictions. Generally speaking, going from maybe places such as West Van, those annual property taxes will be higher than Burnaby, for example. And then finally, capital gains tax and income tax on property. So I'll let Wei talk about this in a little bit more detail in her presentation. So the capital gains tax, essentially 50% of the profits are taxed. And then of that 50% profits, 25% of it it's taxed at 25%. Exceptions are if it's your principal residence. So if you live in that residence and you are selling it, you are exempt, generally exempt from the capital gains tax. And then after, when it comes to income tax, 25% of the gross rent is generally taxed. Then again, I gotta stress that we are not licensed. I'm a licensed real estate agent in BC. I am not licensed to give any tax advice. So if you do have any tax questions, please seek a tax lawyer or a tax accountant. This tax is unique just to Vancouver, the empty homes tax, and there's always a bit of confusion regarding what it actually entails. So the empty homes tax is actually taxed that's specific to the city of Vancouver. So the city of Vancouver, there's an empty homes tax of 3%. It used to be 1%, but it's being increased to 3%. So that's just the city of Vancouver. So if you live in Richmond, you do not pay the city, the Vancouver city tax, empty homes tax of 3%. However, you do have to pay what's called the speculation tax. So that was put forth in 2018, I believe. And what that is that it was coincided with the foreign buyers, the foreign buyers tax that was put in 2018. So essentially, that means that if you leave it empty and you live in an area such as the Capital Regional District, so that's around the Victoria area, the Metro Vancouver Regional District, so that includes places such as Burnaby, Richmond, North Van, West Van, Coquitlam. All of those are in the what called the Metro Vancouver Regional District. If you leave your property vacant, so no renters or you're not renting it out, 2% of the assessed value, you'll pay a 2% tax if you're a foreign owner or a satellite family, or 0.5% for Canadian citizens or PR. So just to be clear on that, if you live in Vancouver and you are a foreign owner, you have to pay the 3% City of Vancouver empty homes tax plus the 2% empty homes tax from the speculation tax as well. So if that makes sense. If you live in Richmond and you're a foreign owner, then you just have to pay the 2% foreign owners empty homes tax. So if you have any questions on that, we can discuss that in the Q&A. And then finally, looking at the recent announcements done by the Canadian government, regarding the recent announcement of the budget in 2022. So there's been a 2-year ban on foreign buyers. So the definition of this, and I took this from the Government of Canada, is that it's prohibiting foreign commercial enterprises and people who are not Canadian citizens or permanent residents from acquiring non-recreational residential property in Canada for a period of 2 years. So in order to be exempt from this, you have to be a Canadian citizen or a Canadian PR, permanent resident, a foreign student, and what I've put in an asterisk is people immigrating to Canada, because that is still not quite clear. From my understanding is that there's no issue as long as you can prove the process of immigration to Canada and what stages you are in. You will be exempt and you'll be able to buy the property. But however, it is important to note that there's no commencement date yet announced for this. So as of today, you can still purchase property in Canada if you are a non-Canadian passport holder or a non-resident as of today. Another big announcement was the prohibition on flipping. So new rules were introduced that any person who sells a property that they've held for less than 12 months, so a year, would be subject to full taxation on their profits as business income applying to residential properties sold after January 1st, 2023. So that's not until next year. And the exceptions that would apply for Canadians are Canadians who are selling their home due to certain life circumstances such as death, disability, birth of a child, new job, or divorce. So there are exceptions to that rule. And lastly, these are a few new additions to the budget. However, I'm not going to talk about these in detail because they're quite specific and might not affect a lot of the people on this webinar today. So without further ado, I'm going to pass it on to Michelle, who will talk about financing.
Thank you, Keelan. Hello, good afternoon, everyone. Happy to be here with you. A quick intro about myself. I'm currently with Royal Bank of Canada, Hong Kong branch, and representing RBC Personal and Commercial Banking. I have been in the Canadian retail banking business for more than 12 years and was relocated to Hong Kong about 4 years ago. And I have been from Toronto. I have been helping Hong Kong clients with their Canadian mortgage ever since. So it's always exciting when it comes down to property purchase. When you start thinking about it, the first thing comes to your mind is always financing. So based on our experience, we would strongly recommend that you have a consultation with the bank before you make offer or purchase to understand what your borrowing capability is for budgeting and what the plan should look like. Think about whether to apply a pre-approval letter first, what other costs might be involved. As Keelan mentioned earlier, all the taxes involved. So whether you are ready now, or if not, what can you do to get ready when the time comes? And the bank usually will have different programs tailored to meet the client needs. For example, the newcomer program tailored to help the newcomer immigrating to Canada, and also the foreign income program for usually Canadian expats or anybody have a strong Canadian tie who has overseas income. So in Hong Kong, this is mostly the case we have. Next slide, please. So before we get into what determines the readiness, it's actually pretty straightforward, the things that needs to be considered. I wanted to actually address the pre-approval letter. It's because so many clients often get confused about the pre-approval letter and think it is the approval for people who bought a pre-sale property, but it is not. A pre-approval letter is to actually give client a close estimate based on their current financial situation on how much they may borrow up to, and taking into account their targeting price. It is a close estimate, not a formal approval. Client would usually use a pre-approval letter to make offer so that they are with more confident and comfortable level. Having said that, if a client was able to bring back a signed purchase agreement within the same month, they obtain the pre-approval letter, then the bank will most likely not ask for any updated information and will issue a formal approval. If more than a month, bank will usually ask for updated employment or income proof, and as well as credit information. So the difference between a pre-approval letter versus a formal approval is that whether the client has signed a purchase agreement or not. If they signed, meaning they bought the property, and then we submit formal mortgage application and they get a formal approval, regardless it is a resale or a pre-sale property. So if they didn't buy yet, they will get a pre-approval letter based on the financial proof that they provide to the bank. So I hope this clarifies and give you a more clear picture of the difference. Next slide, please, Keelan. So what do you need to apply? What do you need to provide the bank for the mortgage application? Usually, we will ask for annual monthly income proof. For example, the pay slips, banking statement showing the payroll deposit, employment letter, potential tax return if you wanted to prove a bonus. Another very important item is the local credit report. So in Hong Kong, it's the TransUnion credit report. Talking about the credit report, so one thing I wanted to remind everybody, let's keep in mind that those loan on card, which is very popular in Hong Kong, with a short time period, but with a big monthly payment, similar to your mortgage payment, would actually greatly impact the borrowing capability. So we would recommend that if we can clean those up before we submit the mortgage application, that would do you a big favor. Okay. The last thing would be the, once we know if there is any loan or mortgage, then we will go for the debt to service ratio, which is the stress test we often talk about. So next slide, Keelan. Those are basically the common terms that we use for Canadian mortgage. One thing worth to note is that in Canada, client would usually be provided a set of rate and term to select max 120 day prior to their final closing. So basically you can take the note as the rate can be only locked up to max 4 months. So for example, if you hear about like 3-year variable rate, 5-year variable rate, or 3-year fixed rate, 5-year fixed rate, something like that. So the 3-year or 4 years or 5 years are the contract term that we refer to with the offer rate. The amortization period will be usually 25 years or 30 years for your choice. The good thing about Canadian mortgage is that there's no age limit. So even if you're 50 today, you met all the requirements and passed the stress test, the amortization that you can choose is either 25 or 30 years. So no difference with anybody else. Next, please. So the next slide is basically clarifies the difference between fixed rate versus variable rate and closed contract versus open contract. So these are pretty straightforward. The only thing I wanted to highlight here is that if client choose a variable rate with a contract term, even the central bank prime rate increase within the contract term, your monthly payment will not change. So for example, this couple months, we all noticed that the rate has been increased twice already. So if client has chose a variable rate, for example, 3 years in the past, and then within the 3 years, their monthly payment will not change, okay? Only the amortization period will be adjusted, right? So you won't see any cash flow issues. So unless the rate increase to a certain benchmark, the bank has to make the adjustment, nothing will change, okay? So usually the benchmark will be around 4.5 to 5%. So next slide, please. So this is basically a process that we would recommend for the mortgage application. And to sum it up, the ideal mortgage application process for clients to obtain a pre-approval letter, or at least have a discussion with your bank to get an estimate before you make any offer. Once purchase has been made, then we can submit formal application and get formal approval for you. Here, there's another concept I wanted to address actually, that is the firm approval versus conditional approval. So a lot of people actually don't pay attention to the difference. So at RBC, we issue firm approval letter instead of conditional approval, meaning that there are no conditions you need to fulfill before final closing in order to get the funding. So it is very important to clarify and confirm this with your bank, whether the approval they issue is a firm approval or conditional approval. As the conditional approval will have a good chance, the bank will review your updated employment or income proof prior to final closing. And if you don't fulfill or qualify, then the approval can be withdrawn. So if people's financial situation changed, for example, if they bought pre-sale in a few years, their financial situation get changed, that could expose you to a risk, okay? So this is what I wanted to share today, and happy to take any questions during the Q&A session. With that, I would like to hand back to Keelan.
Thank you, Michelle. And now I'd like to pass it over to Wei Kang, the partner at Stevenson and Harwood. So Wei, up to you.
Thanks, Keelan. Very happy to be here and share with you our experiences in planning in generally for high net worth families with Canadian connections. I graduated from UBC Law and I practiced at the Vancouver office of a national law firm for about 8 years before moving to Hong Kong. Basically transfer my practice to Hong Kong. I've been in Hong Kong for 3 years. Next slide, please. I'm qualified in BC in Canada, so I regularly assist high net worth families in terms of planning. This includes real estate or other assets, Canadian assets or worldwide assets. When we talk about the planning or tax issues for Canadian people or for people who are buying Canadian residential property. Rather than going through the dry principles of taxes, I will point out some common misconceptions about taxes. As you may know, the Canadian tax residency concept is a fact-driven concept. So whether this person who is buying or owns a piece of property is a Canadian tax resident is a matter of fact. Sometimes if the facts are complicated, we have to do an assessment or determination of the tax residency. Assume this person is a tax resident of Canada, then you're taxed on worldwide income. So that takes you to the table on the right-hand side. In this table, you will see the top income bracket, the top tax rate for residents in the various provinces in Canada. And some of the Hong Kong clients get very much surprised or shocked when they see the tax rate. They thought that there's a mistake. How can you possibly pay over 50% for your, of your income? But that is true. And the threshold income to for the top tax bracket for the top tax rate will vary by province, but roughly speaking, it is about 200,000 Canadian dollars per year. Except for Alberta, their threshold is about is over 300,000 Canadian. So this means if you are a Canadian tax resident and your worldwide income goes above the threshold of roughly 200,000 Canadian, you will pay over 50% of your income as tax. And that income will include the rental income in your residential property. And that will also include the capital gain that you will make from selling your residential property, with the caveat that the capital gain will be taxed, well, with the caveat that only half of the capital gain will be included as income. So for example, if you sell and you make a profit in terms of capital gain of 1 million, you buy a piece of property for 1 million, you sell it for 2 million, you make 1 million in profit. 500,000 will be included in your taxable income. You will have to add up your other income, such as your salary, such as the interest that you earned in your bank account. You add them up. If it's over the top threshold, then you pay the top tax rate. If it's for the portion that is under, there's incremental tax rates that gradually lead up to the top rate. If this person is not a Canadian tax resident, then this person is only taxed in Canada in terms of the income that is sourced in Canada. So that includes again, rental income in Canada and also capital gain that you realize in Canada. So if you're a Hong Kong or PRC tax resident, you go to Canada, even if you have a passport, but if you still remain a Hong Kong or PRC tax resident, you go to Canada, you buy a piece of property, and then you sell it. So presumably you hold it for long term for capital appreciation, you sell it, then you will pay a slightly different tax rate, and that is in the left-hand table. This table is actually similar. This table shows you the different tax rates, but as you see, the top tax rate is 48.84%. So similar, it's actually similar to the top rates in the different provinces. There is just, we single out the different tax rates for non-residents. In this whole process, there is often a misconception that the tax rate is a blanket 25%. I mean, strictly speaking, that is not true, because as you can see, it really depends on how much income, taxable income you have in Canada in that year. However, this is often the case because if you're non-resident, it's actually a hassle for you to sell because there is a withholding requirement. You often have to withhold 25%, sometimes even 50%. So you don't get this right away. You have to withhold and then you have to file income tax return. You only get to pay the actual tax rate in reality a long time after you finish the sale. But if you talk about the bottom line, the left-hand table shows you the tax rates depending on your income. And again, if it's capital gain, you only include 50% of the capital gain as your taxable income. Next slide, please. So after we have a glance of the tax rates, I will discuss some of the issues briefly, the tax issues that we come across when it comes to the ownership of Canadian real estate, because we often get clients or bankers who come to us and say, oh, you know, I want to buy a piece of real estate in Canada. Who should own it? Tell me. You know, the answer is always, it depends. But if I can sum up in one sentence, I want to say that, especially for clients in Hong Kong PRC, where your assets are not exclusively in Canada, the piece in Canada is part of your worldwide assets, you really should look at this as a part of the overall planning. Whether you are going to have one member or the entire family moving to Canada permanently, or you're just looking at investment in Canada as part of your global diversification, you should take a holistic view and plan it. Both bear in mind the tax residency issue that I brought up earlier, and also how this affect the overall family wealth, how you should structure it such that the overall family wealth will benefit, not just having one piece of benefit in Canada. The reason I say that is there's a very attractive factor in being a Canadian tax resident, and that is the principal residence exemption, which Keelan mentioned. He mentioned this earlier. This principal residence exemption means if you live in a property, you sell it, it's a principal residence, you don't pay any capital gain. It's very attractive, but it is only available if you are a Canadian tax resident. If you just have a Canadian passport living in Hong Kong and then you spend, say, a few months in Canada in this holiday home, it is not your principal residence. Sometimes, because a couple will have, sometimes when a family wants to move to Canada, it is not uncommon for the spouse, sometimes the husband, who owns the significant assets to stay in Hong Kong as a Hong Kong tax resident, because he needs to stay here, look after his business. He cannot spend a lot of time in Canada. But his spouse and his kids will go to Canada to live. In that case, you have to be careful who will own this principal resident home. It needs to be the spouse who is going to live in Canada, because she is the only person who can claim this principal residence exemption when she sells the house. If the husband, who is a Hong Kong resident, wants to own this with the spouse, nobody will say no. But when you sell it, you cannot enjoy the principal residence exemption. You have to be careful of that. On the other hand, especially in BC, Keelan mentioned the concept of satellite families. The example I just gave you is exactly the example of a satellite family, where you have one spouse who may make a lot of money in Hong Kong or in Asia, but he does not pay tax in Canada because he's not a Canadian tax resident. But his spouse, who is in Canada, living in the principal resident home, is not making a lot of money because she's only taking care of the family, taking care of the kids. In this case, you are a satellite family, then you have to pay, if you live in BC and your home falls into those areas that are caught by the BC speculation tax, you have to pay the BC speculation tax of 2% because you're a member of the satellite family. Sometimes you cannot get the best of both worlds. You have to pick and choose. And another issue is the issue of capital gain. When we talk about capital gain, we talk generally when a person holds the real estate for long-term capital appreciation. This is different from a person who is in the business of buy and sell real estate. sometimes it is clear, but sometimes the facts can be not so clear. And we noticed there's an increasing trend in CRA, in Canada Revenue Agency, in auditing people when they notice that some people buy and sell properties too quickly. Sometimes, clients do this not really with the intention to flip property, but you just have to be very careful. If for some reason you don't buy this, after you buy this, you want to get rid of it so quickly, you may get the attention of CRA and they may audit it. And sometimes I have some clients who actually just choose to pay. They are tired of arguing with CRA, they think it's not worth the hassle. So you really have to be careful. And plus in the budget, there is a prohibition of, there is a rule that if you flip the property, if you hold it for less than 12 months, you may have to, they will treat it as business income. So if it's business income, you no longer could include only 50% of your gain as your taxable income. 100% will be included. So it is a big difference. Another small point, but is worth mentioning, is the issue of creating a Canadian will. Because even for a non-tax resident of Canada who just buys a property, he or she, if he or she passes away, this will have to go through probate in Canada, and this will attract Canadian capital gain tax. Basically, it's a deemed disposition at death, you have to pay tax. It often makes sense to make a will just governing the asset, the real estate in BC or in whatever province, because this piece of will have to comply with Canadian laws because the asset include Canadian real estate. And also because of the probate fees in Canada, the deemed disposition at death in Canada, it often makes sense and you will have much less hassle if you carve out the Canadian asset in a separate will to be governed by Canadian laws. Because of the time constraint, I will not go into detail about further planning techniques when it comes to owning Canadian real estate. Partially, it's because of the recent ban. There's a ban potentially, we're waiting for the final legislation. There's a ban in owning Canadian residential real estate if you're not a Canadian citizen or a Canadian PR. So sometimes, the techniques that we freely use when it comes to plan for commercial real estate, we have to be careful when it comes to residential estate. When it comes to residential real estate, and really have to discuss with the client, what are their priorities, what are the facts of the family, who are Canadian tax residents, who are not, who has the passport, who is not. So I will stop here and we will happy to take any questions.
So thank you very much for that, Wei. So I'll open it up now for any questions that people may have. So there's a question that says, what is meant by no Canadian tax property for non-resident? Can you elaborate more? I think that might be directed to you, Wei.
Yes, so thank you for the question. Taxable Canadian property is a defined term in Canadian Income Tax Act. What I meant is that a Hong Kong tax resident, if he or she wants to invest in Canada, invest in Canadian real estate, if he or she personally owns it, he will have to pay tax when he sells it, which is obvious. But if he or she owns a Hong Kong company, the Hong Kong company goes in and buy Canadian real estate. And if the Hong Kong company owns other assets, such as Hong Kong real estate or investment portfolio with a bank, then it is a possibility for the shares of this Hong Kong company to be not to be considered a taxable Canadian property. Then when this person dies, or if this person transfers shares of the Hong Kong company to another person, there is no Canadian tax, because this Hong Kong company, less than 50% of the Hong Kong company's asset is Canadian real estate. So this is often a planning technique as part of the overall planning structuring of investment in Canada. The caveat is, as you may have realized, the Hong Kong company is a foreign company. If you want to buy residential property in Canada, this may be a ban because of the recent legislation. Also, you will have to pay the foreign buyer tax if you are allowed to do so. So that's where sometimes the structuring of residential real property, you run into different issues, and it's hard to get the best of a lot of the aspects. Yeah.
Okay, thank you for that clarification, Wei. Any more questions? I'm sure there's a lot of questions out there. One question for you. Oh, now they're coming in. So let's start with this one. I think this one's directed to you, Michelle. So will HK salaries apply for mortgage approval?
Yes. So, but it's actually also need to look into the detailed client profile. So the Hong Kong salary can definitely apply for mortgage, because as I mentioned, the bank usually will have the foreign income program. So would allow our client to use the Hong Kong income to apply for the mortgage. However, the client, him or herself, needs to prove a strong Canadian tie, right? So no question, Canadian expats, like the Canadian resident or Canadian PR, they can definitely approve for Canadian mortgage. If any client in Hong Kong has a Hong Kong income, themselves is not a Canadian, but then they have to prove a strong Canadian tie. For example, their immediate family member in Canada, either studying in Canada or work in Canada, we can also able to do the mortgage as well. Then the person will be the guarantor for the application. So hope that this addresses your question.
Thanks, Michelle. So there's a question that says, you mentioned that the property market has slowed down recently. What is the percentage of buyers who are non-Canadian or Canadian passport holders who are non-residents in the country? And has this segment slowed down in the purchasing of property in tier 1 locations? So I think that one's directed to me. So in terms of the numbers, we can't see the Canadian passport holders who are non-residents. That's impossible to sort of to find out. But the numbers regarding non-Canadian passport holders, so pure foreign buyers, the number is actually very small. So a Baker Real Estate Group, which is one of the biggest pre-sale groups, brokerages in Toronto, recently came out with a report looking at the past 5 years or plus, and looking at all their transactions and determining how many are actually pure foreign buyers. And it was less than 2% of pure foreign buyers. Most of the buyers in Canada are Canadian. The media, I believe, truly believe, tends to blow it out of proportion in terms of the pure foreign, pure number of pure foreign buyers in the market. In Vancouver, that number would be higher. It would be higher than 2. It would be roughly 5% of the buyers. The important thing to understand in Canada is that a lot of people can't differentiate between Canadian and non-Canadian when it comes to looking at these buyers. And some of it, I believe, is a bit of prejudice. So, for example, what tends to happen in Vancouver is that people move to Vancouver when they're relatively young, whether they're going to university there or they're starting their careers there. once you live there for 7 years, you become Canadian. You are a Canadian citizen. And when they purchase property, that is deemed Canadian purchasing, not foreign purchasing. And a lot of people in Vancouver and Toronto might see that as foreign buyers. So to answer your question, the numbers are pure foreign buyers are relatively small. They're not as high as people believe them to be. And I believe these new measures that are going to be put in place by the Canadian government won't be changing property prices in Canada whatsoever, because you only have to look at different markets across Canada where there are very limited foreign buyers and prices are still going up in those areas. In Canada, we have an issue of supply, a lot of limited supply and a high amount of demand. So this year, now that COVID restrictions are down, we're going to see a huge increase in net migration coming into Canada. I believe I was reading that it is something close to 400,000 people will be coming to Canada within the next 2 years. So those people will require housing. So that will be driving up demand as well. So a bit of a long-winded question, but hopefully that answers your question there. We got a question here that says, I'm a Canadian citizen living in Hong Kong. Will I be subject to tax globally if I buy a property in Canada? Even I am a non-resident now, am I subject to foreign buyer's tax if I want to buy a property in Toronto? So I'll let you talk about that way, but let me first answer maybe that last part. So if you have a Canadian passport, you are deemed a Canadian. You don't have to pay any foreign buyer's tax. Your Canadian passport or your Canadian PR card or Maple Leaf card makes you exempt from any foreign buyer's tax. It's also important to note that it's very unclear what's going to be happening with these foreign buyer's taxes, because apparently the government will be putting in bans for foreign buyers. So these taxes will essentially be null if that goes forward. But the key thing to understand is that if you have a Canadian passport or you're a Canadian PR card holder, Maple Leaf card, you will always have the right to purchase property in Canada at the moment. There's no legislation put forth to change those rules whatsoever. So I'll pass it on to Wei, who will talk about the tax side of things. Let me know if you want me to repeat the question for you, Wei.
No problem. I can read it. I have read it.
Okay.
The short answer is no. If you are just a Canadian citizen living in Hong Kong, and presumably because of this, you have cut your ties in Canada, basically you're living in Hong Kong, then you're not a Canadian tax resident. This is not like in the US, where if you have a passport, you're taxed in Canada, you're taxed in the US. So you're not taxed globally. The problem with real estate taxes is sometimes they get confusing because everybody wants a piece of pie. You know, all the taxes that Keelan has outlined to us, if you look at the details, some are levied by the city, some are by the province. Now, most recently, the federal government wants to tax it too. Arguably, they are, whether they're allowed to do it, that's another question, because actually, property, this kind of, that's really the area of the provincial government, not really the federal government. So some taxes, such as what you ask about the foreign buyer tax, that's only targeting non-Canadian citizen or non-Canadian PR. So even if a tax resident of Hong Kong, you're fine. But other taxes levied in the provincial level or in whatever future taxes they may levy, they may target people who are not Canadian tax resident. For example, the BC speculation tax. We talk about satellite family. We talk about if you're not a Canadian tax resident, you're not living there as a principal home, you do not rent it out, you have to pay speculation tax.
So I think we have time for one more question, and I'm sure there's one out there. So we'll wait a bit if there's one more question. There's got to be a question So it's not my first time doing these seminars. There's always questions. There you go. Can we get a mortgage from Canada? I think from Canada for Hong Kong property. I think that might be the other way around. Hong Kong mortgage for a Canadian property.
Yeah, so I think you're looking for a mortgage from a Canadian bank for your Hong Kong property. Is that what you're asking?
Yeah, use a Canadian mortgage to finance a Hong Kong property.
So the answer is no, because unfortunately, the Canadian banks don't actually accept underlying property from overseas. You can actually looking to refinance or finance locally in Canada, but not overseas. But having said that, because RBC have wealth management here in Hong Kong, so if the client is qualified for the wealth management account, and then the wealth management RBC in Hong Kong, we can take into account the Hong Kong property and the local assets for loan. So that if you're interested, you can always reach out to me after the session, and we will have the expert from the wealth management side to talk to you. Hope this is helpful.
Okay, but so before we sign off, I'd like each of one of us to give a takeaway point for our listeners today. So I'll start with you, Wei. If there was one key point from your presentation today that you'd want our listeners to remember, what would that be?
I would like to say the importance of pre-immigration planning, and which also, either pre-immigration planning or planning for investment in Canada. Basically, you have to plan before either you make the purchase decision or before you decide to move in Canada, before you decide to move to Canada. Because of all the tax complications, it is much easier to plan before you make the move.
Perfect. It's always good to be prepared and plan ahead. Michelle, up to you now.
Yeah, so mine is very similar. So as you can see, policy changes over time, as well as borrowing rate and etc. So as we see, there's so much knowledge and tips involved in each of our area along the home purchasing journey or immigration journey. So the takeaway today from me is really suggest all the clients to have a consultation with experts in each of those areas, including a professional real estate agent, i.e. mortgage expert, accountant, tax consultant, real estate lawyer. So you have a whole picture of what to expect along the journey and ensure a smooth and great home purchasing experience or immigrating experience. So that's the takeaway from me. And one last thing I wanted to mention is I'm sure a lot of people are curious about implication of the recent government policy changes. So I have shared an article link with Ken Chan, which is posted by RBC economist Robert Hawke. He has basically categorized all the recent policy and categorize them to address different issues that the government wanted to solve. So it's really worth a read. I hope you will enjoy it, and then you will have a pretty good sense all the rationale behind all the policies. So that's my part. Back to you, Keelan. Thank you.
Perfect. And my takeaway, normally it's on the same lines as Michelle and Wei, which is prepare and understand your financing, because that's always a key issue or a key component when buying property in Canada. But what I would say from my end is to be open-minded when purchasing property in Canada. From my experience in Hong Kong, people tend to be very narrow-minded, very focused on one particular area without having visited that area or having been back in a while. A lot of people that I speak to haven't been back to Canada in many years, and things have changed in Canada. Those neighborhoods have changed. They might not be the same as you remember them. So when buying property in Canada, especially if you're looking to move to Canada from Hong Kong, there are different options available to you, whether it's through the pre-sale property purchasing or resale, buying an investment property beforehand, allowing you to build up that credit in Canada that will allow you to then buy that future home that you want to live in. So that would be my takeaway point, is to be open-minded and to look at different options rather than maybe having a preconceived idea. So that concludes our event for today. I'd like to thank our panelists very much for their time and their insights today. And a big thank you to everyone who joined us today for your participation. Thanks again, and have a nice day, everyone, despite the rain, and hope to see you at a CanChem event in the near future.
Thanks, everyone.
Have a great day. Thank you, everyone. Bye.